This is another strong set of results. Talk us through the highlights of 2022.
Well, I think there were two sets of highlights and one lower light during 2022. So the first highlight was we delivered on our dividend target for a year. So we set a target of 6.54p a share, that's what we paid. And as importantly, we did that on a fully covered basis. So that dividend was 128% covered by our EPRA earnings per share and 109% covered by our adjusted earnings per share. And we set a dividend target for this year, 2023, of 6.77 pence a share, up just under 4% on last year. The second highlight was the continued resilience demonstrated by most of our tenants. So during the pandemic, they were on the front line. And if we're frank, we've been hoping they'd have a chance during 2022 to regroup and have a more normal year, but that wasn't to be. So at the beginning of last year, the pandemic was still very much around. But as the year progressed, inflation spiked to levels we haven't seen for decades. And our tenants, again, rose to the challenge. So if I can give you a very brief summary of what that means for our portfolio at a high level, we grew our annual contracted rent roll last year by 14% to £43 million, while having zero voids, and we collected 100% of the rent due as it fell due. Now, I mentioned a lower light, and that's what's happened in Q4, happened across the real estate sector, as investment yields rose in line with rises in interest rates. So our NAV at the end of the year was 110p a share, down 2% from 112 at the beginning of the year. But what that relatively small decline masks is what happened during the year. So by the end of Q3, our NAV had risen to 116, and it goes down to 110 during Q4. And that was driven by a 4% decline in the investment value of our property portfolio, reflecting a 30 basis point average yield increase across that portfolio. So obviously we were disappointed to see our portfolio decline in value, but what we were reassured by was that relatively modest decline compared to some other real estate sectors again demonstrates that healthcare can be a safe harbour in a storm.
And reference there to the challenging economic backdrop. So exactly how protected is the business and the portfolio?
Well, that's something we've given a lot of thought to when we were setting the business up six years ago, and as we go along, how can we become more, not less protected? So the first layer of protection, and the most fundamental by far, we think, is what our tenants do. So our homes are used by our tenants to provide essential social infrastructure, and demand for that service is not necessarily linked to the wider movements in the economy or ups and downs in financial markets. It's driven by demography and acuity. So that means our tenants can and should be a lot more resilient than tenants in some other real estate sectors. So let me give you a few numbers to try and illustrate what I mean by this. So during the year, our tenants rebuilt their occupancy. It had been badly affected by COVID. It hit a low point of around 70% in January 2021. By the end of last year, it had rebuilt to 88%. So that's still slightly below pre-COVID levels. There's a little bit of way still to go on the occupancy side. But what they didn't have to do to achieve that rebuild was to discount fees. So the fees our tenants charge for the care they provide rose 13% last year, so slightly more than inflation. And that demonstrates, I think, that what they're doing is essential, and when costs rise, those costs have to be transferred through to the end users. Clearly, their costs did rise, but when we look at this in the round at our portfolio level, rent cover, so our tenants' profitability divided by the rent they owe us, it was stable during the year at 1.8 times. So it's a solid level of rent cover, which demonstrates our rent's affordable and they are sustainable. The second layer are the structure and nature of our leases. So obviously the single most important thing in the lease, if it's a long-term leases, and all our leases are long-term and no break clauses, is have you got the initial level of rent right? If you start off over-rented, you're likely to have a problem at some point during a long-term lease. And secondly, inflation linkage. So 100% of our leases are inflation linked. It's a very important principle for us, and it's very useful at a time like this. But they mostly have caps and collars in place, because we put those caps and collars in place to give our tenants a level of protection when inflation spikes, as unfortunately it's currently doing, to make sure our rents continue to be affordable. And then the final layer of protection, at least the way we think about it, is our balance sheet. So we've always aimed to have a conservative, solid balance sheet. Our maximum loan to value is 35%. Our loan to value at the end of last year is 34%. and 80% of the debt we're currently using is hedged.
How important are acquisitions and asset management in terms of Impact's continuing value creation and growth?
Well, since we started the business 6 years ago, we've deployed just over £600 million into acquisitions. And I hope if you look at our track record, we can demonstrate we've always been measured and disciplined in how we deploy capital. We've always been keen to ensure that we're acquiring things on attractive yields, but we're not sacrificing rent cover for yield. We want both high rent cover and an attractive yield. So last year, we continued to execute on that strategy. We deployed £69 million in acquiring 12 homes. We paused all acquisition activity at the time of the mini budget in September, October, because things were so uncertain. It was hard to know where value was. But when we resumed work in October, November on what we thought was a very attractive acquisition of 6 homes in Cheshire and Shropshire. And we closed that for £56 million just after the year end. So that happened post-balance sheet in January this year, 2023. Clearly, looking forward now in this environment, you've got to be extra cautious and careful thinking about acquisitions. You've got to think much more carefully, is what we're doing here accretive to our shareholders, yes or no? We have an attractive pipeline, and we think the answer to some things in that pipeline is yes, it's still clearly accretive at today's higher cost of capital. But one way we have to deploy capital, which we know will always be accretive, is asset management. So what we mean by asset management is expanding, adding capacity to our existing homes, refurbishing them, taking them up market. If it's done well, it's a win-win-win. Everyone gains. Our tenant gains, they're running a better modernised home. The residents and staff who live and work in that home have a better place to live and work. We have a larger home, modernised, paying us significantly more rent. So last year we invested £12 million in asset management. At the moment we have a pipeline of 19 projects with a capital commitment of £37 million to those projects, and we expect to make a yield in excess of 8% on those projects.
How important is sustainability to Impact?
Well, the short answer is very, because we're a long-term business. We need to think about and make sure we are sustainable over the longer term. So we've done a lot of thinking and work on our ESG strategies during 2022. All this is summarised, I hope, usefully in our annual report we published today. It's on the website, the details there. But I'll just point to a few initiatives that we implemented during 2022. So first, we signed up to the UN Principle for Responsible Investment. Second, we voluntarily complied with our TCFD reporting requirements. That's ahead of a mandatory deadline to do so for companies of our size. We have developed a net zero strategy, which will aim to reduce our carbon emissions by 90% by 2045, slightly ahead of the deadline. But rather than just kicking things into the long grass and talking about dates a long way off, I'm glad to say we're actually making progress in the short term. So one example, our greenhouse gas emissions across our portfolio were down just under 4% last year on the previous year. But the more we thought about ESG, the more we thought in our business it should be an SEG strategy. It should be social comes first. Our business, if you think about it, should all be about social impact. So we commissioned one of the leading consultancies in that field last year to help us think better and in a more structured way about what is the social impact happening in the buildings we own. How can we measure it, and how can we hopefully work out that we are doing things to improve it over time? And we're looking forward to publishing their independent report on the social impact shortly. It'll be available shortly on our website.
And taking everything in the round, how confident are you in the outlook for Impact?
Well, to misquote a Chinese proverb, we're condemned to live in interesting times. So I think at the moment, if you say you're confident, you run the risk of sounding and maybe being complacent. So I prefer to say we are cautiously confident, with the emphasis on cautiously. So how can you be confident at any level in such an uncertain time? I come back to the fundamentals of our business. So we own buildings which are essential social infrastructure. We then lease those buildings to tenants where we make a big effort to get to know them well, how they operate, how they do things before we lease buildings to them. And once that's done, our job then is to form a partnership with those tenants for the longer term. A partnership where the tenants can benefit, we benefit, and above all, the residents and staff living and working in those buildings benefit. We all benefit. Now, if we can deliver on that, then we should be able to manage a stable and predictable business in bad times, such as now, as well as good times. So there's a lot of detail in the annual report we're publishing today about how the business performed last year. I'll leave it to all of you to judge, have we been successful or not? And I'd like to thank anyone who's listened this far for listening.